Welcome everyone to our 2021 first quarter outlook. My name is Kevin DeHaut, President and CEO with CWB McLean and Partners. And for this quarterly outlook, we're going to be doing things a little bit differently. I'm looking forward to having a conversation with Scott Blair, the Chief Investment Officer of CWB Wealth Management, and our Director of Research and Head of International Equities, Rick Palumbi. So I'll be speaking with Scott and Rick in a few minutes. Before I do that, I just wanted to give all of you an update on some enhancements we've made to the research team that we think will benefit our clients and allow us to continue to add value on a daily basis with regard to your portfolios. And before I get into it, I just wanted to go back and just give a little bit of a history on how CWB has been building out their wealth management business, because this relates to our research team today. So back in 2008, CWB made their first acquisition of a boutique investment firm in Edmonton called Adroit Investment Management. And a number of the principals they're still with CWB today, and I work closely with them. And 2013 was when CWB took a majority position in McLean Partners. That's, believe it or not, that's been 8 years now. And then in 2020, last year, amid the pandemic, they actually made a significant acquisition where they bought two wealth management companies. One was called TE Wealth. They've been around for 45 years. And the other was Leon Fraser and Associates, and they've actually been around 82 years. So with these acquisitions, we've gotten to a point where in the research side of the business, we now have 15 investment professionals amongst all these companies. And so myself and Scott Blair and Rick Palumbi and other leaders of CWB said, there's got to be a way we can take these 15 investment professionals and really focus them in on each asset class and each mandate and get the best from them. And as a result, it's the best move to make for our clients. And so that's what we did through the second half of last year. And you can see from this graphic, we set up a U.S. equity team, which is comprised of, 4 investment professionals. You can see we now have a Canadian equity team of 3 investment professionals. We've got a fixed income team, and we've got an international team with 4 team members led by Rick Palumbi. So very excited about this, and it makes a lot of sense that everybody's focused. They're coming together, and you're going to hear a little bit more about this in my discussion with Rick and Scott. And you can see Scott Blair is going to be the Chief Investment Officer of this team, and he'll be responsible for leading the team, working with the team, and a lot of the big picture and macro views of the team. So with that, I want to introduce Scott. Scott's actually been in the industry 25 plus years, and he's worked for some billion-dollar pension funds, and he's worked for some smaller investment boutiques. And Scott, welcome to our quarterly outlook. It's great to have you here and great to have you more integrated with our team. And I want to start by just asking you to give us a sense of your background, your experience, and your journey with CWB.
Yeah, thanks, Kevin. Thanks for the introduction. Like you said, I've been working in this business for about 25 years, maybe a little bit longer. And I really started out on the private client side, working with a trust company, managing money for private clients, high net worth people in Ontario. And I did that for the first few years of my career. In 2000, I switched over to the institutional side and started working for pension funds. So I worked at 3 different pension organizations over the next 17 years, with the last one being BCI in Victoria. So BCI is a $150 plus billion pension manager. They manage money for government institutions like BC Teachers, for instance. It's very much like the AIMCO of British Columbia. I managed a 10-person research team there of PMs and analysts, sector specialists covering the whole gamut of the market. So in 2017, I moved over to CWB, and I had lived in Edmonton and worked for the TELUS Pension Fund from 2005 to 2010. And I knew the team at CWB, I knew them well. I knew it was a good firm that was doing well for its clients with very ethical people. And I was looking for an opportunity to really make a difference at a firm, make a difference for the firm, and more importantly, for the clients. And I thought that would be a great fit. And I made the move, and it's been great ever since.
Awesome. Yeah. And I should add that you're headquartered in Victoria. That's kind of, you've been there for the last number of years, right?
I am. I spent a lot of time in Edmonton pre-COVID, but
Yeah.
post-COVID, I've been here with my family here in Victoria.
Awesome. Good. Um, Rick, I want to turn it over to you a little bit. Before I do, I want to start by wishing you a happy 16-year anniversary. This month, you celebrate 16 years with CWB McLean and Partners. So congratulations.
Thank you. Well, quite a journey, and it continues.
Yeah.
I'm excited. Thank you.
You're welcome. Yeah, actually, it's a good point, Rick. Like, speaking of journey, so I'm going to start with a question for you. So, this 16-year journey, you and I have worked together. We've enhanced the research team before, right? And we continue to raise the bar with the research team over that 16 years. My question is, with this enhanced team and the way we've broadened out the size of the team and having these kind of focused individual mandates, do you see that changing our investment process or investment philosophy at all here at McLean and Partners that our clients have become, accustomed to?
No, Kev, I actually believe that expanding the research team will allow us actually to focus more on our process and philosophy, to continue to enhance it, evolve it, do what we're doing and continuously improve it and get better at it. I think it's tremendously beneficial for the clients, actually. And getting to know the team, we definitely have more similarities than differences. We are all fundamental bottom-up stock pickers, believe in active management as a means of adding value for our clients. So we're definitely aligned. I'm excited about the team, and we're already seeing the benefits. First, I'm looking forward to welcoming Edward Friedman back to the international team. As many of you know, Edward has been running our Canadian equity pool. And while he's going to be involved in Canada through the transition, ultimately he'll bring us tremendous analytical skills to our international portfolio. And also, it's been great to watch how the U.S. strategy is taking shape. Many of you know Saket Mundra, who's been running our U.S. equity portfolio. But in the new team structure, he will be co-managing U.S. equities with Lily Zvetkova, who many of you will come to know. She's currently the PM of U.S. equities at AIM. And, their styles are extremely complementary, and they help each other, raise the research bar. And I've witnessed that firsthand recently as they've, and the rest of the U.S. team work closely to figure out intel, which, we may hear about in future updates.
Awesome. Okay. Thanks, Rick. And Scott, back to you. So, this similar question, this new structure of 15 professionals focused, how do you see that benefiting our clients from your perspective?
Yeah, it's a good question, because you only do it if it benefits the clients, right? And I've been a big advocate for doing this change. We have really strong talent across all the firms. What I've been struck by at each firm, and McLean and Partners is no exception, is the passion for the industry, the passion for the work and the business, and it's very, very high. So we had proper team sizes before, but we didn't have a lot of depth on those teams. So, when you have two people looking after a certain asset class, adding a third or even a fourth, depending on where it is super beneficial. It adds more depth. It lets you be more nimble and more focused. And I think perhaps one of the best long-term consequences of this is just the continuity. So being a bigger group, that allows us to look at potentially adding new asset classes down the road, or expanding assets, and that helps us to really train the next layer of portfolio managers within the firm, gives the younger people more opportunities to grow and develop, and helps us to really have that continuity of philosophy and process. And all the best investment firms in the world have that continuity. They have that kind of progression within their firms, and this really helps us to do that. So I think it's going to be a win-win for everybody.
Awesome. No, good. Thank you. Rick, just back over to you. So you're going to be taking on a larger role as head of international equities, and the international equity team will actually be 100% based in Calgary. How are things going to be evolving for you and the rest of our team here in Calgary?
Well, I think, for us, it's business as usual. I mean, the core of the team remains the same, with Jimmy and Imran, and obviously adding Edward back to the fold. I think, what can I say? It's extremely what I consider to be a high power team. And, we look forward to being able to focus internationally. I think it will expand, our footprint internationally, and we'll be able to look at, other areas of the world that, I think it's tough to do when you're focused on the size of the team and how you're approaching it. But I think now we should be able to expand and bring in new and exciting companies into the portfolio. So I'm very excited about it.
Yeah, super. Yeah, no, I know the three of us recently have been, like, the emerging markets have been getting a lot of attention as 2021 started, and I think roughly, Rick, we got about 20% of our international funding in emerging markets, but I know that's an area that you and the team want to expand some of your coverage in.
Absolutely. Absolutely.
Yeah. Okay. Well, that's great, gentlemen. I think I've got two of the brightest investment minds out of our CWB team here with me today. I'm going to take advantage of that and ask you guys a couple of investment questions now that we've kind of went through the enhancements in the team and how that's going to benefit our clients. Scott, I think I'll start with you. Like, one of your roles as chief investment officer is kind of looking at the world from a more macro, big picture perspective, right? And then letting the teams kind of do the micro, bottom up stock picking. And I read some things recently that I just have to share before I kind of ask you the question, and kind of relates with 2020. And everyone knows, there's been tremendous fiscal stimulus, right? Huge fiscal stimulus from the governments. And on the central bank side, we kind of knew this was happening, but when I read it, it really kind of stuck out to me. There was 190 interest rate cuts in 2020 by global central banks, 190. And this is going on today. Central banks are buying about 1.3 billion of securities every hour. Most of it's bonds. They're not really buying stocks per se, but some central banks are buying stocks. But 1.3 billion of securities every hour. So, it's been quite a tailwind, coming out of 2020. So how do you see 2021 shaping up? And what's your outlook for 2021 from a macro perspective?
Yeah, it's a good question. All those bond purchases, that's printing money, right? That's what they're doing. The central bank, the government's issuing bonds, and the central bank's buying them, and that's putting more money out in the economy. And we're really excited about 2021 and 2022, actually. So when we take a look at what the forecast is for GDP growth across the world in 2021 and 2022, those 2 years combined will have the highest GDP growth that we've seen this century. So we've been through a very deep recession, but very, really very short. And the government really paid people to stay home. They supplemented incomes. Some areas of the economy did very well. Usually when we come out of a recession, especially a deep one like this, people's balance sheets are in terrible shape. Their debt levels are high. They're trying to rebuild their savings. This time around, and we have a chart up that you can see, this time around the consumer is flush. So they've got a lot of money saved, and they've got their debt levels are at great positioning. So the consumer maybe has never come out of a recession in better shape than they have this time around. And that is very good for the stock market. So we're pretty positive on 2021 and 2022 so far. You know, things can obviously change, but I'm excited about the next couple of years.
Awesome. And Scott, I'm going to stay with you because, you know, there does seem to be a lot of optimism out there right now, believe it or not, with regards to the economy and the stock market especially. But, you know, with optimism, I know one of your jobs is also to kind of keep an eye on, you know, the risks on the horizon and what are some of the things that, you know, could derail this expansion and this optimism.
Yeah, I mean, you spend just as much or more time on what could go wrong than what could go right. And with so much, like you mentioned earlier, all of the money being put in the economy, there is no doubt we are going to see inflation rise. It's an inevitability, and we've got another chart on that here. Economists aren't looking for inflation to rise to levels that are obscene or that would be very hurtful for the economy. But still, we are going to see when people get back, when the economy starts opening up, people are bored. They've been home for a year or more, and they're going to be spending. They're going to be out restaurants and bars, concerts, sporting events, traveling. You know, there's going to be a lot of spending going on, and it's inevitable we'll see the inflation rate rise. Now we could see the market start to get concerned about it. We could see bond yields rise, and that could cause sell-off in the market. You know, sell-offs are normal. We would think if nothing else changes with our thesis over the next 2 years being strong years, we would see that kind of a sell-off as likely an opportunity to buy stocks in the equities.
Yeah, and it's quite frankly, I don't think we've had a correction since March of last year, and that was a you know a 30%er. I don't think we want one of those, but you know the reality is corrections are normal and they happen every year, at least once or twice a year at you know kind of 8 to 10%. So you know we'll see how things go here, but we're probably due. It's just you never know when they're going to come.
Yeah, stocks don't go up. They don't tend to go up in a straight line like they have the last 9 months. You know, it's been pretty amazing downturn and then a pretty amazing recovery here. But yeah, I agree with you, Kevin.
Rick, I'm just going to come over to you. It's kind of a similar question, but I know, you know, you're looking at the world with the team from a little bit more of a micro level, a little bit more of a portfolio and sector level. So as you're kind of looking at the world through your lens, what do you see as some of the opportunities kind of from a portfolio sector level and you know, what's kind of driving things in the market currently?
Yeah, I think if we drill down a little deeper into what Scott was saying, I think we believe a key theme for 2021 will be this normalization of interest rates and definitely a steeper yield curve. So the chart that you're looking at is the 10-year U.S. government bond yield. You know, it has risen 60 basis points from, you know, March of 20, and it's climbed over that psychological barrier of 1%. Now, as important as the absolute level of yield is the actual shape of the yield curve. So as the economy gathers momentum, you know, yields in the short end of the curve, that's normally defined as 2 years or less, they rise more slowly than yields in the long end of the curve, defined as 10 years or more. And this has the effect of steepening the yield curve. And this is exactly what's been happening. So when we look at this chart here, the difference between the US 10-year and 2-year bond, has climbed steadily from a low of approximately 10 basis points, again in that March 2020 area, to as high as almost 1% recently. So as the macro environment Scott discussed earlier gathers pace, and with the US Federal Reserve holding short-term rates firm, we expect, you know, this steepening yield curve to continue in 2021.
Right. Okay. Yeah, and I think Rick did a great job of explaining what a steepening yield curve is, because it can sometimes be, you know, a little complex at times. So, and like obviously, as the yield curve started to steepen, we noticed the market start to kind of rebalance itself. Rick, we talked a lot about this, you and I, in November, and I'll let you maybe explain then what this rebalancing is and what sectors are starting to benefit from a steepening yield curve.
Yeah, historically, periods of rising U.S. bond yields and steeper yield curve have had positive effects on global equities. Over the past 20 years, the MSCI World Index has risen 6.6% on average during these periods, 92% of the time. So pretty good odds. And while both U.S. and European equities have tended to fare well in absolute terms, they rise, 5.9% and 6.3% respectively. Again, the hit ratio there, or the probability, has been 100% of the time. Actually, European equities have outperformed U.S. During this time period. So when we look at breaking down the performance from a sector level, and we have a chart here kind of breaking that down, it's not surprising to see that the sectors which benefit most from improving economic cycle, like resources, autos, industrials, banks, and materials, they tend to perform better at the expense of more defensive sectors such as real estate, consumer staples, and healthcare. We saw it in November, beginning in November, and we've seen it sort of continue into 21, and I think that's something that will continue as the year progresses.
Well, thanks very much, Scott, and thank you, Rick. And Scott, we're excited to have you joining our quarterly Outlook commentary, and we look forward to introducing other team members throughout 2021 to our client base. I'd also like to mention that we're going to have a written commentary of each asset class with this quarterly outlook, and you can find that commentary on our website. So I would encourage all of you to check that out and review our commentary. And with that, I want to wish all of you a happy new year and wish you a very safe and healthy 2021. And we'll be talking to you next quarter.